Hi, and thanks for watching the 12% Solution. Today I'm going to share with you the 5 warning signs that it's time to sell an individual stock. Number 5 especially is one that most people overlook. Now, if you're a fan of this channel, then you know that we favor investing in ETFs, or exchange-traded funds, over investing in individual stocks. But we also know that we're human, and that means we often fall for the siren call of individual stocks, whether we're wanting to go all in on AMC or GameStop, or perhaps something more stable like P&G or Apple. If we can't help ourselves and we have to own individual stocks, then it's important that we know exactly when it's time to sell. So these are the 5 warning signs that you should look for to possibly sell your individual stock. I should stipulate that these are warning signs that it's time to sell a stock based on the company's action, or lack thereof, as opposed to any macroeconomic trend in the offing. And also, remember that there is no magic wand. The data that feeds a decision to sell is fluid. It requires judgment, and that judgment is part art and part science. But there are a few things that most analysts will agree are warning signs. And here's number 1. The company's competitive advantage is diminishing. A company's competitive advantage can be anything from low prices, like Walmart, to patents, think IBM and Apple, to branding and marketplace goodwill, think Coca-Cola. And it's that competitive advantage that provides a moat of protection around the company, keeping at bay any would-be competitors. But if those competitors can build a better mousetrap or find a better way of serving customers, that competitive advantage can disappear quickly. Think about the pitched battle between Walmart and Amazon, with Walmart now offering the convenience of online shopping with its traditional low prices. And of course, there's the behemoth IBM, which has long been losing market share to more nimble competitors that have been able to adapt more quickly to changes in personal computing. Most companies need to hold some form and degree of competitive advantage in order to facilitate future growth. If you diminish that advantage and future growth, and the company's corresponding stock price is suddenly in jeopardy, then you need to be prepared to sell. This brings us to warning sign number 2, changes in leadership. Some companies are built on the visionary leadership of their founder. Think of Apple and Steve Jobs, Microsoft and Bill Gates, or Facebook and Mark Zuckerberg. And what happens when those companies lose their visionary leader? While dramatic changes in leadership can really alter a company's future performance, it doesn't have to. An engineering mindset, lofty goals, and a unique corporate culture can be so embedded in the company that existing employees or fresh management can take the reins and drive performance to the next level. But visionary founders do bring something to the table that others often lack. You might think of it as the product or service instincts that put their company on the map in the first place. Or it might be a sort of star quality that attracts positive media, investor attention. But the loss of a company's founder often marks a turning point. Think of Microsoft, when Bill Gates turned over the reins to Steve Ballmer in the year 2000. The company entered a 13-year period of missed opportunities and really botched product introductions, and a share price that lost 35% of its value. Conversely, when current CEO Satya Nadella took over in 2014, Nadella promptly imbued the company with a new personality, got some important things right, like cloud computing, and investors have witnessed a more than doubling of Microsoft's stock to date. Change is unavoidable, and most successful companies will end up losing their formidable founders at some point. That doesn't have to mean a death sentence. But if you're holding the company's stock, the event does need to grab your attention. You need to ask yourself, is the business model that made the company successful up to this point still intact? Then you need to evaluate the new leadership. Do you feel they can pick up and carry on? Or does uncertainty cloud the company's future? If it does, you need to be prepared to sell. Which brings us to warning sign number 3. Shares are flagging. Shares are a key driver of company growth, and companies that deliver revenues that increase at a faster rate than competitors, those are considered growth companies. and they often deliver share prices that outperform as well. But keep in mind, sales do not go straight up forever. The overall economy, for example, can take a toll on sales of even the most aggressive companies. But the economy aside, a trend of declining revenues can signal problems. It may be a first sign that the previous competitive advantage is diminishing, which was warning sign number 1. Or it could be that the product or service is reaching a saturation point in the marketplace. The once innovative concept of the smartphone has become so ubiquitous that it's now more aptly labeled a commodity like light bulbs and salt. And with that market shift comes shrinking revenues as key players that were once engines of growth fight for scraps among a shrinking customer base. Whatever the reason, stalling or falling sales spells trouble for a company's share price. Now, absent a corporate history of acquisitions or an imminent campaign to drive new technologies or products to the marketplace, flagging sales can definitely be a signal to sell. That brings us to warning sign number 4. Earnings are shrinking. Among all the metrics employed by legions of analysts to predict the future, quarterly corporate earnings are probably the most scrutinized. Earnings are simply the after-tax net income of a company, the revenue left after deducting expenses, interest, and taxes. Shrinking corporate earnings is definitely a red flag. While there can be some good reasons for a decline in net profit for a particular period of time, say a company is redirecting a larger share of revenues to research and development, or maybe there's a marketing push to drive a new product, a trend of shrinking earnings, absent such qualifiers, can be signaling that the company is having trouble managing costs, or maybe having trouble meeting revenue goals without throwing money about wildly. If you are beginning to see a trend of shrinking quarterly corporate earnings without a corresponding surge in responsible investments, then yeah, you better be prepared to sell. Now, before we move on to warning sign number 5, take a moment to subscribe to this channel so you don't miss any future videos, including investing tips and ways to build your wealth. So here it is, warning sign number 5, a dividend cut. Now keep in mind, not every company pays a dividend. However, those that do pay a dividend are often prized by investors seeking marketplace maturity and a stable income. And those companies that raise their quarterly dividend payments are often signaling optimism about the future, garnering even more goodwill from investors. Conversely, companies that cut dividend payments, regardless of the spin placed on the action by management, are often signaling tough times ahead. Dividends are usually paid out from company earnings. If a company sees earnings weakening in the future, dividends are one of the first things on the chopping block. Of course, that's not always the case. Freeing up cash by reducing dividend payments could be used for research and development, factory expansion, or some other arguably useful purpose. But any cut in dividends should send up a red flag. Unless it's crystal clear that cash that would have been dividends will now be spent in support of growth, you need to be prepared to sell. Hey, that wraps up the 5 warning signs to look for when you're holding an individual stock. For more information, you can check out Stock Market Cash Trigger by David Allen Carter, which highlights a simple technique to avoid losing money from crashes, corrections, or bear markets. Leave us a comment regarding future videos you'd like to see, and feel free to like this video if you've enjoyed it. Thanks for watching and happy investing!